Hello and welcome to Different Choices 2021. We're going to give it about 2-3 minutes to let people get in and then we'll start. All right, so we're going to get started and we'll let people in as they arrive. Welcome everybody to Different Choices 2021. We're really glad you're here. This fair is presented by Schools for Children and the workshop is Understanding Your Credit Score, which is presented by TDBank's Fabienne Rat. I'm Nina Rate. I said it all. I asked you a million times and then I said it wrong. I'm Nina Fiore and we're glad to have you here. If you have questions, Fabienne's going to give a presentation. If you think of questions while she's presenting, just put them in the chat and then we will ask, we'll leave a good amount of time for Q&A at the end. So if you don't want to forget your question, put it in the chat and we'll be asking Fabienne for you. If you have any questions you don't want your name associated with, like if personal finance info you don't want us to announce or anything, you can just send it to me or Raymond personally, and then we'll ask for you anonymously. Okay. So we're really glad TDBank agreed to do this with us. It's a wonderful service they do for the community. So I'm going to pass you over to Fabienne, who will introduce herself and also begin the presentation.
Hello, everyone. Good afternoon. Thank you so much for having me. I am Fabienne Rate. I work at TDBank and I'm a store manager in the Plainville, Connecticut location. I'm so happy to join you today to talk about credit awareness and how important preparing your credit plays into reaching financial goals. So during the workshop, we're going to explore easy ways to build, maintain, and repair our credit. Next slide. We can go to the next slide. So the introduction to credit. These are some frequently thought of questions, things that go through everybody's mind when they're thinking about credit. So credit is, it's a tool and it's an important aspect of our finances, but it can be stressful and it can be hard to understand the ins and outs of credit. So these are some common questions. So does checking your own credit lower my credit score? The answer to that is no. How often should I check my credit report? And that varies. So checking your credit report frequently can give you an up-to-date know of what's happening with that credit report. Are there any errors? Has anything changed? Is anything reported incorrectly? So it's important to periodically check your credit report. What do I do if there's incorrect information? So we'll talk about that as we go through. How is credit score calculated? How do I improve my score? In what financial situations is my credit being checked? How does it impact my score when a lender checks it? Should I have one credit card? Should I maintain credit where I hold my checking account? How do I choose the best credit card? So these are all great questions that we're going to touch on. Next slide. How is a strong credit score going to help you? We're going to explore how credit scores impact our financial choices, accessing and understanding credit reports, building, maintaining, and repairing credit, and credit card tips and strategies. So we'll cover the following as we go throughout. Next slide. So what is a credit score and how does it influence our daily lives? If you go to the next score, we're going to break it down a bit. The next slide, excuse me. So a credit score is a number that is given on your credit report, and there's various things that make up a score. In general, scores range from 300 to 850. The higher your credit score, the better credit worthiness you have with potential lenders. So there's an example. There are 3 major credit bureaus: Equifax, Experian, and TransUnion. Not all credit is reported to each major credit bureau. So that's why scores differ. When you apply for an auto loan or a credit card, the lender may only access one credit report. When you apply for a mortgage, for instance, the lender may access all 3 credit reports and take an average of those scores. So you could have an example here showing we have one report, the score is 726. Another report, it's 698. A third report, it's 711. They're very close, but then they differ. And the reason they differ is because scores are not calculated in the same way. So each credit bureau will have a different scoring based on certain things that come up on the credit report. For instance, a late payment could affect the score, and it could affect it a little bit differently from each credit bureau. Credit history and the behavior from the credit is what derives your score, right? So the 3 major credit bureaus are what are pulled by lenders in order to check the credit history and credit worthiness, and that they use that to help make decision on whether they're going to extend credit. So having a healthy score and knowing how to manage that score and to repair or build the score is an important part of credit awareness, and it's an important part if you're preparing to either buy a home or to take out any sort of credit for an automobile, if you want to take out a credit card, etc. Okay, let's go to that next slide. So these are some factors that make up the credit score. Payment history is a very big part of your credit score. So if you have on-time payment history, it will affect your score in a positive way. So it will help build and keep your score strong. If there's unpaid debt, specifically to the percentage of available credit you have out on your credit line, that could draw your score down. For instance, if you have a credit card out and it's maxed or spent the entire line, that can drag your score down. A good habit is to have at least 30% of your credit line available. That will help keep your score in a positive light. The length of history you have with your creditors also affects your score. The number of new credit applications taken in a certain period of time also affects your credit score. And the types of credit that you have and how long you have had them affect your credit score. So there's a lot that goes into that formula. Okay, next slide. So again, we talked about the importance of checking your credit report, and we've touched upon how often that should be. So annually, you get 1 free credit report from each major credit bureau. So it's a good habit to touch base at least annually on your credit report. Now, if you're working on repairing your credit, or if you had mistakes on your credit, you might access it more frequently, or sign up for a free like annualcreditreport.com, so you can go on there frequently and check as you're repairing or looking to see that things are corrected. These are again, the major credit bureaus and their website and phone numbers. So Equifax, Experian, and TransUnion are some important ones to know, and you can find that online and access their customer service numbers. We also have our resources added to your website as well, so that you can link these easily. All right, next slide. So there's an example of somebody that is about 29 years old. This is an example of things that had shown up on a credit report and how they could affect your credit. This could be seen on anybody's credit report, depending on your situation. So this is an illustration. So on your credit report, you're going to see some identifying information. So your full name, social security, your number, the social security number and address. So this is important and this helps your credit score. Current credit card use. So this particular illustration, the person has 2 credit cards with less than 10% of a balance. This would help a credit score. Car loan payments are showing 1 late payment in the history. A late payment past 30 days will negatively affect the credit score. The age of your credit accounts. So for this particular illustration, the person has an account that's 10 years old. So that's a very long account. And so the longer that your credit history is on your report, the better that will help your score, especially if they're on-time payments. Hard inquiries are going to reduce your credit score. And a hard inquiry is when you apply for a new line of credit. Derogatory marks, collection items, for instance, a utility bill that may not be paid or may not be accurate could derogatorily affect your credit score. That's why it's important on checking if there are any errors, you find out ahead of time rather than when you're actually applying for a mortgage or applying for a credit, then you're rushing to fix those mistakes. So if you look at it periodically, are in the know of any mistakes or things that don't belong, you can address them and they'll be all fixed ahead of you going for a new credit item. Okay, let's go to that next slide, please. This is a checklist on how to look up your credit report. So when you first look at your credit report, it could be daunting because it kind of all is gibbered together and there's a lot of information on there. So this breaks it down for you and it lets you know what to look at. And it's a good tool to use as you're reviewing the credit report so you know what you're looking at and it will help you to determine if there's any errors. And let's move on to the next slide. So building, maintaining, and repairing credit, there's no major magic formula to building strong credit, but there's a lot of good habits and there's a lot of good guidance. Most importantly is if you're able to pay your bills and loans on time every time, even if it's just the minimum payment, this can help keep your score strong. Don't close your credit limit to the max, right? Stay at least 30% of the credit limit open and available. Have high credit limits. Ask to get it increased and use it responsibly. Don't close your old cards because that can erase the good credit history that you've put on the report and that you've established. Only apply for new credit accounts when needed. Again, opening a lot of accounts or applying for many things in a short period of time, it can drag the score down. And fact check your credit report. Again, periodically looking for inaccuracies and errors. And our next slide. If you find something that does not belong to you or there's an error, it's important to address it, as soon as you can. And these are some steps on how to do that. So you want to contact the major credit bureaus and let them know the error that you found. You can do this by writing a letter, providing the account number of the item you feel does not belong to you or may be inaccurate. Explain concisely why you believe it's not accurate. And if you can, include copies of bills or any proof, let's say that you've paid the item, a receipt that it may have been paid so that you can accurately show the credit bureau that that needs to be removed. Provide your address, phone number, so that the credit bureau can contact you back and if you need to further investigate the item. Make a copy of the letter and keep it for your records so that you have it on file. Send your letter possibly registered or return receipt mail so that you know exactly when that credit bureau has received the item that you're disputing and that they're going to be investigating the claim. It usually takes 30 to 45 days for them to work on that claim for you and to get back to you with an update. Let's go to that next slide. Sometimes things can get off track, and taking steps to rebuild credit are important. So it takes time. It does take time to rebuild your credit, but it definitely can be worked on and it definitely can be corrected. Review your report. Create a plan for reducing outstanding balances. Improve your payment history. If you need to, call in and discuss it with your creditor. Try to make a payment plan. Talk to your banker. Talking about secured credit cards, credit builder loans. There's many products out there to help establish if you're starting out and rebuild credit if you need to. Those are important tools to help get you back on track. And our next slide. How can credit cards hurt your score? Let's talk about that. So let's go to the next one. So a credit card is it's a financial tool, but sometimes that financial tool can be it can be like viewed as like a hindrance, right? It can be viewed as a stressful thing. It takes discipline when working with any financial tool, especially a credit card. So the thing with the credit card is there's a cost to the convenience. So you put something on your card and you get your bill at the end of the month. Good habit is to try to purchase only what you can afford in your monthly budget and pay it off at the end of the month. And that could be the challenge because it is so easy to swipe the card and we make purchase that we say, oh, I'll pay that next month or I'll pay that in the future. Then it begins to accumulate interest. And so for that convenience, it's now costing interest for the item that you purchased. You have to be responsible with your credit card. So low balances and paying on time are great credit score builders. Read your fine print and understand what you're applying for. So there are some credit cards that have no annual fees. There are some credit cards that do have annual fees. There are some that come with cash rewards, and there are some that have various interest rates. So it's good to understand what you're applying for and know the card that you're getting into. Stay in the know. Read any letters, correspondence, emails, and notifications from your creditors and from your credit card company. And if you are in a hardship and can't make the minimum, call them. Let them know what's going on and discuss it. Make a plan so that they know that you're going to work on it and that they've got a note on file as what's going on, and so that the card isn't just left or forgotten about. And let's move to that next slide. These are some great resources to help understand more about FICO score, how to access your credit report, how to learn about personal finances and financial education. So we have a learning center at td.com, and you're able to click on that link and register to do some personal development on finances. Now we're going to open it up to questions. I know I saw some things come up in the chat. Let me just see if I can open this back
Raymond,
up.
do you want to stop sharing the slides? Wonderful. All right, so I know I saw some things come through when you asked about what happens when about closing the card, leaving it open. So Janelli asked, what happens when you don't close the card and leave it open?
So if it's a card that you've had for a long time and it's a card that you've had great payment history with, you just kind of leave it there. And it's not that you have to use it, but it's still sitting there out on your credit history to help with your score. If you close that card, it will erase the history that you had. So it will actually drag your score down. It's always recommended not to close a card. If you open one and decide quickly that you don't want it, that will still probably ding your score a bit, but it's not the same as if you've had a card for 10, 15, 20 years and you've been using it, periodically, and you're always paying on time. That is good credit history. It stays with you. And so that's why it's recommended not to close it.
And then the next question from Narun is, how long should you wait to open another credit card account if you do close one?
It really depends. So that's the other thing is about starting out. If you're starting out, a great secured credit card is the way to go. And what I say is use that card on things that you would normally buy, like maybe your gas, your food. Instead of buying a bunch of stuff just to help establish or reestablish credit, use it for things you would necessarily need and then pay it off at the end of the month. I would say that it takes at least anywhere between 6 to 12 months to actually get some good history on your report. So before I took on another card, I'd at least wait that time frame. Now, if you're looking to get into home ownership or things of that nature, you need a few credit lines open and available to show that you've had that credit history. That could include 1 or 2 credit cards. It could include a car payment or an installment loan. So there's various types of credit that can be on your credit report aside from a credit card, but the credit card is easiest way to get started and to establish some history. So long story short, I'd say let's wait about 6 to 12 months before applying for another line of credit, especially if it's new.
Why do banks check your credit score if you want to open up an account?
We actually don't check your credit score if you open an account. There are some banks that will check your history with accounts. So they may run your information through a third-party verification system to see how you've done with banking in the past regarding overdrafts and things of that nature. But we're actually not able to run your credit report unless you actually apply for credit. So if you're going to apply for a secured card, a car loan, a mortgage, a personal loan, we would run your credit at that point. But just to open a checking or a savings with a debit card, we actually don't pull credit.
The other question is another question. What should I do if I think my account has been hacked?
If you think your account has been hacked, the first thing you want to do is contact the bank right away. Because if you see something on your account, just as we were saying about your credit report, anytime you see something on your bank account that you feel isn't something you authorized, you want to contact your bank immediately. So depending on what type of transaction that is, bank will guide you whether you need to close your card, close your account. It all depends on the type of transaction and what transpired. But best course of action is to call the bank right away, talk with somebody, and they'll guide you through that scenario.
Another question, is it worth using apps like Credit Karma? Do you recommend any apps like that?
Yeah, Credit Karma is actually a good app because it doesn't cost anything. They're well known. The score is going to vary, and I touched base on that a little bit earlier in the presentation. Each creditor has their own scoring depending on what's out on the credit report. So they vary a bit, but a Credit Karma it's like a good estimate. It's going to give you an idea of where you land. It may not be exactly where the credit report when it pulls, but it's a very, very good estimate, and it will be a good guide to where you are.
And you had mentioned earlier in this slide, it said like if you're not able to make a payment, like pick up the phone and call the bank or call, is that,
Absolutely.
is that helpful?
It absolutely is helpful, because if you have a situation, life comes down everybody's pike. There's certain things that come up, and
Especially lately.
especially late in it, and especially things we've seen in the pandemic. But it's always a good course of action to make a plan and discuss it with your creditor so they know what is happening. They can notate your file, and a lot of times they can work out something with you, whether that be a payment plan or, depending on the type of credit, sometimes a rate modification to make things easier. There's a lot of things that can be done. So it's always a good course of action to speak up and see, if there's an agreement that can be made. It
Janelle
definitely
asked,
shows responsibility as well.
yeah, I mean, I think people don't realize that because you're like trying to avoid it. But if you pick up the phone and face it, it does have its benefits, no?
That's part of finances, and that's part of credit. So there are great things about it, but there can be some stressful things, and sometimes it is hard to face. But if you're able to, and in a good, spot that you can communicate with your banker or with your creditor, it is going to be the best course of action.
Janelle says, do you have any tips for people with no score who are just starting out with their credit cards?
Absolutely. So if you have no score yet and have not established any credit, your best bet is to set up a secured credit card. So the secured credit card is, it's a smaller line of credit. So it's a good thing to wet your feet with. Now with the secured credit card, you have to put a certain amount down. Generally, they start at about $300. So you put $300 in a savings account. The bank then extends a credit card to you. It's a real card. As you make your payments on time, it reports favorably to the credit bureau. Now on the reverse, if there were late payments, that would show on the credit bureau as well. If for some reason the line of credit isn't managed properly, the collateral would be taken. So there's not a lot of risk involved. Again, it's a very easy step to get started. And if you're starting on the right foot of making your payments on time, that will there build your credit and report favorably to the credit bureau month over month.
Would you recommend, like, if you're not able to make the full payment, make a payment? Like, never just leave it be?
Yeah, absolutely. So that's the other thing with the credit card is, as long as you make your minimum payment. So you could get your bill of $200, let's just say, I'm just using an example, and your minimum payment is $20. If you make your minimum payment, even if you can't pay that whole credit amount that was spent off that month, it's okay. As long as you make your minimum payment, that will report that your payment was complete and on time. If you're unable to make the full minimum payment, it's better, I think, to make some sort of payment than to skip the payment. So if you're able to come up with half, but again, I would recommend reaching out to your creditor and just letting them know, hey, this was a tough month. Maybe you were sick, whatever could have transpired. Let them know and say, this is what I can do. I can send you $15 this month, or I can send you, half of the payment. And that way they'll put it on file. And I think that's, will help better than skipping the payment.
Sam asked, when should you go from a secured one to a regular one? Like, what's your
So
recommendation?
that can happen, again, depending on the use and depending on the other items that could be in somebody's credit file. Everybody's credit file is different. Everybody's credit experience is different. So there's no set timetable, but again, it could be anywhere roughly between 6 to 12 months. I can explain at TD that we will automatically look after 7 months to see if it's time to graduate to the regular card. And once it's time, we do that automatically for our customer, send a letter, say, congratulations, you're graduating, and release the collateral back to the customer. It's just in their savings again.
So does the bank usually determine that, or do you don't really determine that? Is that true?
The bank will actually determine when it's time to graduate. They'll periodically take a look on the history of the new card, how it's been going, and the customer's credit history, and say, you know what, we don't need the collateral anymore. They've shown good credit history. They're maintaining this line well. We're going to graduate to the regular card.
Great. Other questions? What have you seen, like what types of loans do people take out for college that you've seen? Like what's available for that if it's needed?
Through colleges, there are obviously loans that you can take right through the school, like actual student loans. At the bank, what's offered can be borrowing from your equity that you've established in a property. So a home equity loan or line of credit can be used for college expenses. Sometimes people use credit cards for books, expenses. Sometimes even you can pay tuition depending on how much it is on a credit card. There are various types of installment loans or personal loans people might access to help with college expenses. So those would be what's available at the bank level to help finance school.
And a home equity loan, is that, I mean, that sounds scary. Is it as scary as it sounds?
It is a little bit more in depth than like a credit card that we were talking about. The differences on a home equity loan or line of credit is you have to own a home and there has to be equity established in that property, meaning that you've paid it down and maybe there's no mortgage or maybe there's a small mortgage left on it. Depending on the value of your property, that determines the equity and what you might owe on it. And we calculate what can be used of that equity in a loan. And so that loan can then be used for anything. It can be used to buy a car, to go to school. It can be used for a wedding. It could be used for emergencies. It can be used, for vacationing. There's no limit to what you can use it for. The thing that is different is that you have to have equity in your property in order to qualify for that loan.
So you have to have at least paid off some of the mortgage and have
Or, yes, that's correct. You either have to have paid off some of your mortgage to build up that equity, or your property can appreciate over time. So depending on how the market is for homes, because markets change, it can go up and down. So depending on what the market is, property could have appreciated. In the reverse, a property could depreciate. So the equity can change either way, depending on home values at any given time.
Janelli asked, just to clarify, the credit card is money that the bank lends you and you pay back, and how much money can you take?
Yes, a credit card, it's an open, what we consider an open line of credit. So when you apply for a credit card, they're going to qualify how much you can borrow based on the income. So how much money you have able to repay the line of credit. And again, they're going to look at your credit history and your credit experience. So those factors will determine what you qualify for. So for instance, the secured credit card that I told you about, it starts at 300. An unsecured credit card starts at 1,000. And so once you get a credit limit established and you work with that credit card over time, periodically, again, bank will check in and they'll say, oh, they're doing very, very well with their card. Everything's been paid on time. We're going to increase their credit limit. So as your credit grows and you're building that history, you have the ability to get an increase in your credit line, even sometimes without asking. Just happens.
So you have to prove responsibility before they're going to give you access to more lending money, basically.
Absolutely. A lot of credit means responsibility, and it means on-time payment, and it's like a cycle. You're continuing to do those good habits, then your credit score grows and your credit experience grows, and then your responsibility grows.
Narun wants to know again, what's the difference between a secured card and a regular one?
The secured card is you have to have some collateral to back up that card. So you would have to have $300 that we would set in an account, and then we extend the credit limit so that if something goes wrong, maybe the card isn't maintained or paid, we just take the collateral and close the card. It satisfies what could be owed on the card. An unsecured or a regular credit card has no collateral to it. It's your promise to pay the bank back. You're just signing that you're going to pay back. But in the discussion that we had today, you have to start somewhere to establish credit. And a lot of times that secured card is your easiest way to get started. Once you use that tool to build and show that you're paying on time and being responsible with that line of credit, then it opens up the door for other things for, credit wise.
Oh, so what happens when you don't pay, like back, like then what does that set in motion? Like, if you could walk us through that a little. If
Yes,
you're not paying
absolutely.
your bills, what then happens on the bank side? Like,
So what will happen is the first month, so you could be late on a bill a day or two, life's busy, you're like, oh my God, I've, got home late, I forgot to make that payment. You make it as soon as you remember. 1 or 2, 3, 4, 5, 6, 7, 29 days, it doesn't report to the credit bureau. Anything 30 days or more past due, that's when it actually reports to the credit bureau as a late payment. So at that point, now it's on credit history that the payment is late. It will assess on the bank side a late payment because the payment never came. So you get a late payment fee. So now you owe the minimum payment plus the late payment fee. So now it's probably almost double of what would have been owed if it had been paid when the bill came, plus interest costs. And if a second month comes where there is no payment made, it begins to snowball, and then it becomes harder to catch up with those payments. On the bank side, another late payment fee will come down the pike, and you'll receive notice of late payment and trying to get that payment satisfied. Eventually, if too many months pass, what happens is the amount that's owed will go into a collection status. And so then from there, the bank or creditor will just assign because they've tried to get the payment or they haven't heard from the customer. So they'll just assign it to a collection bureau to try to get those payments and to try to get the debt satisfied. And so then that will also be reported to the credit bureau, and again, further pull that credit score down.
so basically, and you were saying like a call or some type of outreach to the company can help you greatly in that situation.
It can. I mean, anytime you're able to make a payment arrangement, it's going to be more favorable than if it's just left and forgotten, because it just ends up snowballing. And then once it gets into the collections, it can still be paid, it can still be satisfied, it can still be updated on the credit report, but then more fees and costs are incurred in that. So it ends up where could have been a small amount, but it ends up being very stressful and hard to catch back up on, depending on the situation and how far it goes out.
So would automated payments kind of be your suggestion to try to
Automated
help
payments,
that?
automated payments are a great tool, because if you know that you're going to have the money in your account on the due date, it's a great tool to ensure that your payment is just paid on time. It's seamless. You don't have to worry, and you don't have to worry about forgetting. you get busy at work, busy with kids, busy with life, it's just done and it's paid, and you don't, it's just seamless. So definitely automated payments. You can set up bill pay through your online banking and schedule a date for certain bills to be paid. And so then it's literally done for you. It's all, just have to make sure that the money's in the bank account for the days that the payments are coming, and then the bills get paid on their own.
So what happens when you end up with a bad credit score? Like, what can you do to make that better?
The biggest thing is to find out what is wrong on the credit report, what's dragging the score down. So is it a late payment? Is it possibly a collection item? Is it maybe an error? Maybe you paid something off and it didn't get reported properly. So those are all things that can be worked on. If it is a collection item, again, reaching out to the creditor and trying to settle and make payment, satisfy that debt. If it is late payments, you want to try to turn that habit to being able to pay on time as best as you can, because that will help to bring the score back up. And if it is an error, you want to get that taken care of as soon as possible, because an error it'll stay there until it's fixed with the credit bureau. Once the error is removed, or once the debt is satisfied, it will help with your credit history and your credit score. And some people are very, what's the right word? Very particular about their score. It means a lot to them. It's almost like a secret pass. And so I could see as somebody, it's a big thing, because if you work towards building that score, you want to keep it as best you can. Again, life happens and things happen, and it can always be fixed. But once you get to that spot where you've worked on it and built that score, you want to keep it, and it's a proud moment. So definitely it's a big, big thing. The other suggestion is, if after school you have put things on credit cards, or you have some credit card debt that you want to help in managing, it's always a good idea to go down to your local banker and talk about it, because sometimes there are other things that you can do with that debt to reduce your interest costs or to reduce your payments, so that when you make your payment, more of that money is going down to pay it rather than just going towards the interest costs. So it's always good to explore, hey, I've got this amount of credit card debt, or I've got this amount of debt. What options are out there? Is there a way that I can reduce some of my interest costs so I can pay this off quicker?
Can you explain that a little more, kind of the principal and the interest differences?
Yeah, so the higher that your interest rate is on your debt, the more costs is associated, but it's not helping you pay your actual debt down as quick, because more of your payment is going towards those interest costs. So if you can reduce your interest costs, the money that you're making on your monthly payment, more will go down to actually paying that debt, rather than it'll flip itself. So instead of paying more in interest costs, you're going to flip it so you're paying more down on your principal, and you're going to be saving in interest costs. So it will just help you to pay that debt off quicker.
And is that something you have to kind of request? Like, I want this money to go to principal?
Yes. Well, it depends on the type of debt that it is. So on a credit card, that's the other thing about credit card, is when you get the bill, it's just a minimum payment, and that's interest. That's basically your interest costs. So if
Ah,
you just pay that minimum payment, your balance is really going to stay there year over year, and it illustrates that on your bill. It tells you, if you just pay your minimum, you're going to be paying this balance for X amount of years. Now, if you get into the habit of paying additional amount, that's when you start chucking off your principal, and it starts to bring your balance down. So it depends on the type of debt, but in general, the lower that your interest costs are, the less expensive it is for you to have that debt, and the quicker you'll be paying it off, because your money is going to go towards the balance rather than going towards the interest costs. There's always interest, that's going to be inevitable, but the lower that you can get that rate, the less expensive it's going to cost you for that debt.
And can you adjust rates if like the economy changes, or how are rates set, you know?
You kind of have to shop around. So that's why I suggest reaching out to a banker or researching it online. Sometimes you could find a lower interest credit card. Sometimes you can find a personal loan with lower interest and kind of refinance that debt into a different vehicle. Sometimes you
Yes.
can find promotions on credit cards where it's 0% for a certain period of time. That can help you to kind of manage that debt and set a budget and say, you know what, I want to be done with this in 12 months. Let me pay $100 a month. The end of that time frame, I'll be done with this debt. So it's important to be educated on what tools are out there, because everybody has debt. We need it to get from point A to point B, but it's a good course of action to kind of look out there, see what's out there, inform at the bank or inform, online, and research for the lowest, interest rate that you can get. So it saves you money.
Yeah, that's a really good idea, kind of like if you find a lower personal loan, transferring your credit card debt to the personal loan. Yeah, I hadn't even thought of that.
Yeah.
Janelli asks, can you downgrade from a card like regular to secured, or one with a lower minimum payment? So is that something you can choose to do?
So the minimum payment will really be geared towards the balance that you have outstanding on the credit card. So the bigger balance you have, the way that they calculate a minimum payment on a credit card, it's a certain percentage of the balance you have outstanding. It can be like 2%, 3%. Again, it's a little amount because it's mainly just the interest costs. So that minimum payment may not be the same depending on, month over month, depending on what balance you carry. If you don't carry a balance, and so what we talked about earlier in the presentation is kind of getting into the habit of using your card and then paying it off at the end of the month. Then you don't accrue any interest costs. You're using it, but for stuff that you would normally buy. So the money's sitting in your checking account, you get the bill and you pay it off at the end of the month. That might actually gain you some cash rewards or some sort of a reward, because a lot of cards come with a reward program. So you could actually make money on your credit card if you use it in that manner rather than paying money for interest costs. If you decide, you know what, I need to buy something to fix my car, and I don't have the X amount of money in the month to pay it all at once, but I'm going to pay it over 2 months or 3 months. So then you'll make a decision on how much you can pay on the monthly budget. You work with your card in that manner, it's going to be less an interest cost for you than if you're carrying a balance, only making that minimum payment. It's going to cost you a lot more in interest costs. And again, it will leave that balance there for some time until you're able to kind of make extra monthly payment.
Makes perfect sense. So we have a few minutes left. Any other questions before we wrap up? Fabienne, thank you so much.
You're
You are
welcome.
wonderful. We really appreciate this. If anybody wants more information, tdbank.com has a whole education site, financial resources. I mean, it's wonderful, really, what you all have. Thank you, Janelli. Thank you for your questions too. And yeah, I was really impressed by all I saw there. Like, I could go off and teach a class if I put all your resources together. Like, it really is a wonderful service.
Thank you so much. Great resources there. And you have my email. So again, anytime that you might need or have questions, feel free. I can email you. I'm happy to help. And this is a great topic and a great way to get established for the future. So TD Bank is very, very big on financial literacy and ensuring that people understand all aspects of finances, because it's a lot. It's a lot to manage and to learn and to understand. So we're definitely here to help and to support. So if there's anybody that, needs anything, you've got my email and I'm happy to assist.
Thank you. And we'll also be sending out the recording of this along with the resources links and the presentation so that you have it if you need it. And we'll be emailing that to everybody who signed up for it, so you don't have to reach out. We'll get it to you. Thank you, Fabienne. You were
Thank you.
wonderful.
Thank you so much for having me. It was a pleasure. And I hope
Truly
you
our
guys
pleasure.
have a great evening. Thank you again.
Thank you. Bye.